So where we stand today is we have a recessionary contraction in leading economic data. It took about a year to a year and a quarter longer than normal for it to show up in the cyclical economy, but it has just started to show up as a contraction in cyclical sectors. The aggregate economy is still performing just fine, about on trend, which is why the stock market continues to perform well as most financial assets, because they're most tied to the cyclical economy or aggregate economy, excuse me. And then the lagging or services economy, which unfortunately is what a lot of people focus on and does not give you a good read of where things are going, is still doing quite well. So things are okay as defined by the aggregate economy right now. However, we should be aware that leading economic data has not improved from its recessionary stance. The contraction has begun to show up in cyclical economic data, which means in time it will show up as a deeper downturn in the aggregate economy, although there's still likely a little bit of time before it gets there.
On this episode of What the Finance podcast, I have the pleasure of welcoming back Eric Basmajian. So Eric is the founder and CEO of EPP Research Cycle Research. So Eric, thanks so much for coming on the podcast today.
Good to be with you, Anthony. It's been, I think we said over a year since the last time we talked, so it's a good time for an update, I think.
Yeah, definitely. Lots of news recently. Election, Fed,
That's right.
football. Yeah, but it's funny.
Never a dull
look
moment.
back, never a dull moment. We get caught up in the highs and lows sometimes, and you look back, and it's just what sort of going up. In oil, and it's just sort of flat for a. There's these ups and
Exactly.
downs, but really,
That's
it's
right.
looking at longer term cycle. But yeah, where I'd really like to start is I like to start very broad and see where you take it. So, what is your current outlook on what we're seeing in the economy?
Sure. So, generally, I like to answer the question just by giving a quick background of the way that I analyze the business cycle or the way that I analyze the economy, because it can be a little bit different than most people are familiar with. Um, I follow business cycles and I primarily focus on the US business cycle. And while business cycles across time have a very specific rhythm or a very specific order of operations in which they follow, and we are following the very normal order of operations or very normal sequence of events. This time or this business cycle is a little bit unique in the sense that the lead and lag time of some of these transitions from, let's say, step 1 to step 2 or step 2 to step 3 are taking longer than they normally do in this post-COVID cycle here for a variety of reasons, which we'll get into. I'm going to show a quick slide just to help articulate the process that I use. What we're looking at here is the what I call my business cycle dashboard. So this order of operations or this sequence that we follow is basically looking at what we call 4 economies or 4 different cycles. We have a leading economy or leading cycle, a cyclical economy, an aggregate economy, and a lagging economy. The leading economy doesn't measure any actual economic activity. What the leading economy measures is what we would call soft concepts or soft commitments, things that give us an indication of where actual economic activity will go in the future. So the leading economy is generally represented by things like building permits for new construction. You're not actually measuring any activity with a building permit. It's just an application for future activity. Something like manufacturing new orders. It's, again, not measuring any employment or any production activity. It's just a commitment about a future new order, as well as things like the stance of monetary policy proxied by the yield curve, monetary and money supply indicators. So what we're looking at is the availability of money and credit, as well as soft commitments. Again, we're not measuring any actual economic activity in that leading economy bucket. The cyclical economy is the most important bucket in my view. The cyclical economy is the first place where we begin to measure actual economic activity, and we're measuring production or output as well as employment for the construction and manufacturing sectors specifically. And the reason that we're so focused on the construction and manufacturing sectors specifically is because these are the most volatile, the most interest rate sensitive, the most credit sensitive, and where all recessions or all big booms in the economy originate from. They always originate from the construction and manufacturing sectors. The aggregate economy, as the name suggests, is the whole pie. Everything in the economy, all employment, all consumption, all production, everything put together. And then the lagging economy is primarily measuring services consumption and services employment. Services are not interest rate sensitive. They're not credit sensitive, which is why they're the last thing to feel the impact. Generally, what has to happen is you need to experience job losses in the cyclical economy, job losses of construction and manufacturing. And only once those people lose their jobs do they become the stress on the aggregate and lagging economy. So, with that very long winded explanation, we can now refocus on this chart here, and we can see that the leading economy or leading variables have been contracting or in a recessionary stance for over 2 years, as this chart measures the growth rate from 24, 18, 12, 6 months ago, and the most recent data. This is why the recession conversation has been active for so long, because these leading indicators have been in a recessionary stance for over 2 years. Normally, the lead time between a contraction in leading data and a contraction in cyclical economic data is about 6 to 8 months. However, what happened this cycle is the leading economic data was contracting for 2 years. And just now, 24 months later, are we just seeing the first signs of contraction in the cyclical economy? So we're seeing a decline in the number of residential units under construction, a decline in manufacturing activity, a decline in manufacturing employment, although the declines are somewhat mild still. If we don't have a persistent and deep contraction in the cyclical economy, which has only just started, then the aggregate economy will not come down. And we can see that that aggregate economy bucket has been extraordinarily stable, right at approximately the trend level of growth. And then, as the sequence would suggest, the lagging economy is still performing above trend because you don't have a below trend or contractionary state in the aggregate economy. So where we stand today is we have a recessionary contraction in leading economic data. It took about a year to a year and a quarter longer than normal for it to show up in the cyclical economy, but it has just started to show up as a contraction in cyclical sectors. The aggregate economy is still performing just fine, about on trend, which is why the stock market continues to perform well as most financial assets, because they're most tied to the cyclical economy or aggregate economy, excuse me. And then the lagging or services economy, which unfortunately is what a lot of people focus on and does not give you a good read of where things are going, is still doing quite well. So things are okay as defined by the aggregate economy right now. However, we should be aware that leading economic data has not improved from its recessionary stance. The contraction has begun to show up in cyclical economic data, which means in time it will show up as a deeper downturn in the aggregate economy, although there's still likely a little bit of time before it gets there.
Okay, great. Thanks. That's really interesting to see the visuals there and sort of how you look at things. So, do you have a hypothesis, I guess, on why this lag has been so much longer than previously? I get, I could throw out some ideas, but I'm sure you've thought about this a lot, so I'll let you go into it.
Absolutely, it's a really important question, and it's one that was you know related to a lot of abnormalities during the pandemic. So I wouldn't particularly expect this duration of lead time that we're experiencing this cycle to persist in cycles of the future. But with that being said, what happened was the cyclical economy, as I referenced in those slides, is the most important sector of the economy. You cannot have a recession without a contraction in the cyclical sectors. And conversely, all the booms in the economy are related to the cyclical sectors. So the cyclical bucket is really where the focus should be. So why was there such a lag between the contraction in leading indicators and the contraction that we're just now starting to see in cyclical indicators? In my view, of course, with the benefit of hindsight now, what happened was that when we were in 2020 and 2021, the government provided a lot of stimulus to households as well as businesses. And most of that increased demand was channeled through this cyclical economy, through the consumption of things like durable goods. People were at home ordering a lot of goods because you couldn't consume services, of course, as well as a big boom in housing because of the extremely low interest rates, as well as the migration that was happening from various states, which caused a big boom in housing activity in those states that were absorbing a lot of the migration. Simultaneously, while we increased demand, we, of course, constricted supply through shutdowns and things like that were, of course, happening around the world. So it wasn't completely in our control. But we had a phenomenon where we increased demand and constricted supply. Of course, that led to a burst of inflation, but more importantly, what it led to was an extreme accumulation of backlogs in the construction and manufacturing sectors. So, for example, and I'll use just a hypothetical. If there's a car manufacturer and they produce 10 cars a year, let's say, and they receive orders because of really artificially stimulated demand of 100 cars, but they only produce on average 10 a year. They maybe can squeeze out 11 cars, 12 cars, 13 cars, but there's no way that they can fulfill 100 car orders when they normally fulfill 10 without expanding their production capacity. And that's not a solution that they can use in the short run, because to expand production capacity means you have to open up new factories. This is a multi-year process. So what happened was we had 100 orders of cars, to use a hypothetical, when the capacity of the industry was about 10 a year. So you can push that capacity to, like I said, 12 or 15 or something thereabouts, but you, of course, cannot get all the way to 100. So what that means is you have a backlog that builds up, and you just have to deliver the cars the next year or the year after. So we created about 2 to 3 years worth of backlogs in key industries of construction and manufacturing, given how extreme we stimulated the demand, as well as how we constricted supply of these people, manufacturers able to get these goods. So then what happened after that was we had the initial burst of inflation. So the Federal Reserve began raising interest rates. The increase in interest rates is what caused the leading indicators to go into contraction and start signaling or flashing red. Normally, when the leading indicators contract, that tells you that these cyclical industries will begin to get rid of employees because their sales will slow. The Federal Reserve raised interest rates from 0 to 5 very quickly, and everyone expected that that was going to have a very negative impact on these industries. However, these very interest rate sensitive sectors, which normally respond very quickly to these changes in interest rates, for a period of time were rendered completely insensitive to interest rates because they were still producing backlogged orders. They weren't producing orders based on the prevailing interest rates and the prevailing trends. They were producing orders that were given to them in 2021 and 2022 when interest rates were 0. So the Federal Reserve raised interest rates really high, contracted leading indicators, and everyone said, okay, here comes the contraction, but they still had these backlogs that they had to chew through. So interest rates remained high, and the contraction did not show up. It did not show up. It did not show up. And that led everyone to believe that, hey, maybe things are different now after the pandemic, which logically doesn't make sense because you can't take interest rate sensitive sectors and make them insensitive to interest rates permanently, but we did make them insensitive to interest rates temporarily. So what happened was we had multiple years worth of backlogs that these two sectors had to chew through before they started to face sort of current conditions. It took way longer than I had originally anticipated, I think, as well as most people. Now, as we're starting to see the end of these backlogs and most of these industries have chewed through their order books, they're now having to face current conditions and current interest rates. And the sales volumes at these current interest rates is very lackluster. Very low levels of housing volume demand, very low levels of vehicle sales. So now, as those backlogs have cleared, are we now just starting to see the rollover in that cyclical economy, as I showed in that chart? So this was a phenomenon of demand that was stimulated in 2020, 21, and 22 that took multiple years to dissipate because of backlogs that were accumulated in our most critical sectors. Once those backlogs have now cleared, we're starting to see the rollover and contraction. The Federal Reserve is starting to ease interest rates. So there's a little bit of a competition now between how fast the Fed can cut and how hard the contraction appears in these cyclical sectors. But as the backlogs are now gone, sales volumes for housing and vehicles remain low. We're likely to continue to see more contractions spread through these cyclical sectors, and that will put downstream stress on the rest of the economy. But in my analysis, that's the primary reason for why it took so long and why the economy has appeared interest rate insensitive for such a long period of time.
Yeah, that makes a lot of sense. I should have said what I was what I was thinking before, because I was thinking exactly inventory and maybe a bit of immigration, but you said it a lot more eloquently than me, and and why that's greatly impacted the US, potentially why they've maybe benefited at a greater rate than the other countries globally.
Yeah, and I can give another example. These are actual real numbers, and I wrote an article on my Substack about this, so you can see the charts if you go to the EPB Research Substack. Um, the residential construction sector, residential. There's a lot of talks about non-residential, but the real key sector is residential construction, the construction of single-family houses as well as apartment buildings. The residential construction sector, the home building companies, when they have units for sale, what they list as inventory, inventory can be listed when it's completed, so you can move in tomorrow. They can list inventory when it's under construction, or they can list inventory when it's not yet started, sort of just like a picture in a book. You can buy a house out of a picture in a book, and then the company will start the construction. So you could have inventory that's not yet started, under construction, or completed. For about 50 years, from 1970 to right before the pandemic, 2020, the amount of inventory that was completed was about 20 to 30%, a pretty tight band. So construction companies would try and keep about 20 to 30% of their listed inventory as completed move-in ready. So that means 70 to 80% was under construction. Think about it that way at any given time. During really bad recessions, that amount of completed inventory starts to swell, which is why they stop new construction and they lay off construction crews. But 20 to 30% is the really tight historical band. In 2022, which was the peak of the demand for housing, as well as the most constricted supply conditions, we had 8% of new home inventory completed, which means that 92% of the new construction inventory was under construction. 92%. So what that means is that, in theory, if the Federal Reserve raised interest rates to 10% or 12% or 15%, and I'm of course getting hyperbolic, but you can understand where I'm going with this. if the Federal Reserve raised interest rates to 10%, the way recessions occur is because that increase in interest rates causes a contraction in the demand for homes, which causes a contraction in new construction. If builders aren't selling anything, then they don't want to build anymore. And if they're not building anymore, they have to lay off those employees, and that's what starts the spiral. But because the builders were in a situation where only 8% of their inventory was completed, even if the Fed raised interest rates twice as high as they did and sales volumes dried up, which it did, the backlog, just to get back to that normal range, that 20 to 30% level, required them to just keep building and keep building and keep building, irrespective of what the interest rate and prevailing conditions were, because they were in such a backlogged state. So um, that is now at about 24, 25%. So we're now back to the historical averages, which is why we're starting to see the building permits slow down, as well as the employment in the construction sector ease off a little bit, although it's still not negative. So it's been a very funky cycle, you could say, because of that. And I wouldn't think that this particular cycle that we're experiencing would be a good template for cycles going forward, unless we expect to really stimulate demand and constrict supply and create these really generational situations in backlogs for key industries. But I wouldn't think that that would be the proper base case going forward.
Yeah, it's really neat, really interesting sort of example of the inventories, and not something that I guess the average person would think about. But you mentioned there there's sort of a race with time for the Fed to cut interest rates fast enough to sort of offset this weakness in I guess consumer sentiment and demand, etc. Do there's been recent economic data or inflation data that's come a little bit hot. Do you think that's because they're going to start questioning the trajectory, or do you see it continuing to go the way it currently is?
So I think that there's two conversations about inflation that I think are worth having. And I'm putting up a slide here on monetary growth. Hopefully you can see this one as well. The conversation of inflation as it pertains to consumers and what we all feel on a day-to-day basis is a relevant conversation. And on that basis, there was a large step function increase in inflation. We're not going to get that back. That really disproportionately hurt lower income people in the country. And that's a real issue politically. But the Federal Reserve, for better or for worse, targets a 2% rate of inflation. And Powell, in his last press conference, explicitly said that they're not going to try and push inflation below 2% to make up for the above 2% inflation. Now, we can all debate whether that's good or bad, but for the purposes of trying to assess Fed policy, we have to assume that 2% is their target, and they're not going to try and push this to 1%, let's say. So PCE inflation, headline PCE inflation, over the last 6 months has been 2.1%. It's been about 2.3% for the headline CPI. The Fed uses the PCE, but whether we use 2.1 or 2.3, the Fed is mostly back at their target, talking 10 basis points or 20 or 30 basis points away, which is certainly given them enough confidence to begin cutting interest rates. The latest inflation reports, when we say it's hot or it's cold, we're talking about, a tenth higher than expected or a tenth lower than expected. But the trending interest rate using the Fed's measure of PCE inflation is about 2.1. All inflationary episodes, all big inflationary episodes are preceded by big increases in money supply growth. Now, not all increases in money supply growth create big inflation, but all big inflation is preceded by big increases in money supply growth. So we had, which is not represented on this chart, but we had 20 to 30% money supply growth in 2020 and 2021, which preceded the big inflation that we had. So what I'm showing on this chart here is the growth rate of various measures of money supply. There's a measure called true money supply, or TMS2, which is for the Austrian School of Economics. They like to use a measure called true money supply. The definitions or construction is not overly important. We have our standard M2 measure of money supply, and then we have our big, broadest M4 measure of money supply. And again, in this chart, what I did was I showed the growth rates from 24, 18, 12, 6 months ago, and most presently. And I also denoted for each measure of money supply the average rate from 2012 to 2019, which was a period of time of relatively stable inflation, below trend or roughly on trend inflation, as well as roughly stable economic growth. So what you'll notice in the chart is all three measures of money supply are below their historical trends. So the Austrian TMS2 measure is about 1.6 growth rate, M2 is about 3.5, M4 is about 3. All of these are below trend measures of money supply. And going back to the comment that I made initially, was that all big increases in inflation are preceded by large above trend increases in money supply. So, given that statement, I don't believe that we are on the cusp of a second wave of inflation that's going to go back to 3, 4, 5, 6% like we experienced. With that being said, what you'll, of course, also notice in the chart is that the rate of change is increasing a little bit. Um, we were contracting money supply across all three measures, going from, -8 in the case of TMS2, or -3 12 months ago in the case of M2, or about -1% for M4. So as the Federal Reserve has eased their monetary restriction, slowing the pace of quantitative tightening, cutting interest rates, the rate of money supply growth has increased across all three buckets. And it's very important for us to keep an eye on where these rates go. Because if we do start to see the rates of money supply growth push up towards their, pre-COVID averages and then exceed their pre-COVID averages, then we would have to be on very high alert for a potential second move up in inflation. But given that we are still, in most cases, well below the long run rate of money supply growth, in terms of Fed policy and that 2% barometer, we're unlikely to see big increases in the inflation rate that deter the Fed from cutting interest rates. And what that means is that the conversation as far as Fed policy shifts entirely to the employment mandate. And we can get into the employment side, but just very briefly, what we've seen there is we had a period of time about a year and a half ago where the unemployment rate bottomed at about 3.4%, and it increased to 4.3%. So that increase in interest rates from 3.4 to 4.3 worried the Fed very much, as well as caused a reignition of recession fears in the economy. And the Fed came out of the gate strong with a 50 basis point cut as a result of that. Over the last three reports, the unemployment rate has gone from 4.3 to 4.1 and has now stayed at 4.1, which is why we've just recently started to hear conversations about the potential for a pause in these interest rate cuts. If the unemployment rate does not continue to rise, then the Federal Reserve would have confidence that the inflation rate's in pretty good shape, the unemployment rate is in pretty good shape, and as a result, monetary policy is in pretty good shape. But given the first chart that I showed on that business cycle dashboard, where we're starting to get the weakness appearing in those cyclical sectors, I would expect the employment picture to continue deteriorating, albeit perhaps slowly, which should keep the Fed on a slow cutting path for the next several quarters, in my view.
Okay. Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in, and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views. We've hundreds of thousands of different people listening in. So I just wanted to thank you. I started this as a student, and now currently working, and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening, and let's get back to the show. Okay, that makes sense. And it's sort of once and I know it probably depends on the different sort of data points you use in the different parts of the cycle or their money supply, but once it sort of starts to permeate into the 6-month trend, is that when you sort of think it becomes, it's more going towards that trajectory? Because I imagine 1 month of data is, it's not enough to really show that.
Yeah, so all of the growth rates that I showed in the chart are 6-month growth rates. So, they're not measuring just month to month. So these are all 6-month growth rates. So where we stand today doesn't appear to be concerning as far as a level of monetary growth. However, if we continue to see the rate accelerate over the next couple of quarters, that could potentially precede another bout of inflation. But it's very difficult to have large increases in the money supply while the yield curve is in an inverted state. We had very large increases in money supply in 2020 and 2021 from more of an unusual vector, which is the federal government sort of doing, what is commonly known as like a helicopter drop of money directly into people's bank accounts. And that caused a really large increase in the money supply. That's generally unusual. Most monetary growth or money supply growth comes from the private sector or the banking sector. The banking sector is the primary industry that generates new increases in money supply. So while the yield curve is in an inverted state, which it still is, and even if it slightly uninverts, we're still very, very flat. It's not highly profitable for banks to lend very aggressively. And without robust paces of bank lending, it's unlikely that you see large increases in money supply unless we see another COVID-like stimulus, which I don't think is on the radar, considering there's no present recession as well as no major emergency like lockdowns or global health crisis. So just looking at those variables, if I was to look out, 3 months or 6 months ahead, the conditions for huge increases in the money supply don't seem present, which means that the inflation picture 3 to 6 months, in the future from there, don't appear to be a massive risk as far as the Fed is concerned. But I, always keep a close eye on these dashboards to always have a refreshed picture on any given month of where we stand on these measures.
Okay, thanks for the clarification there. Yeah, and I'd be interested to hear more about your opinions on employment, because you sort of gave us a little bit of insights there, but it's something that you mentioned that you are dig a lot deeper into. And from my perspective, if I think about it, you said that the government has sort of basically given a bucket of money to everyone, but it's sort of almost the same for the employment, because they've sort of employed a lot of people, from my understanding, versus where they maybe what they previously have in the past. I don't know if that's had an impact, or maybe you can go further into.
Yeah,
So,
it absolutely has. A lot of that money has, of course, ended up back on the balance sheet of many companies. So I have a employment dashboard here as well. I talked about the unemployment rate, which is obviously the measure that the Fed looks at. But just like the business cycle dashboard that I showed, employment moves in a sequence as well. You're never going to have a contraction in service sector employment before you have a contraction in manufacturing or construction employment. Because as I mentioned, it is the job losses in construction and manufacturing that causes those people who are now unemployed to pull back on service oriented consumption, like going to restaurants or going on vacation. And only then do those companies feel the effect and then begin to lay off employees, which is why the employment and services is very lagged. So what I have here is a sequence that goes from left to right of various employment buckets. So starting on the most left part of the chart, which is the most cyclical area of the economy, or the area that would experience job losses first, we're looking at residential construction and durable goods manufacturing. So you can think of the construction of buildings, the people that are actually on top of the roof hammering nails, for example, or the people that are actually on the production line of durable manufactured goods like cars. The next bucket from there would be the total construction sector, which includes both residential and non-residential, as well as the total manufacturing sector, which includes both durable goods and non-durable goods like food, beverages, clothes, and things like that. The next bucket from there would be the total economy, so total non-farm payrolls. Of course, that total being highly influenced by the first two buckets. And then the last bucket to feel the employment effects is non-cyclical employment, which is just the total excluding construction and manufacturing. So when we go from left to right, again, we're looking at the growth rate of employment 24, 18, 12, 6 months ago, and most recently, which is October. Starting on the very left-hand side, you can see that 24 months ago, residential construction and durable goods manufacturing was growing employment at 3.5 or 3.4%, which is a very robust pace of employment growth. Most recently, that's now dropped to zero. The broader construction and manufacturing sector has similarly slowed down, although not to the same extent, mostly buoyed by non-residential construction, which is why it's the next bucket. That's currently growing at a rate of 0.4, previously was about 1.5, 6 and 12 months ago, or about 1, 6 or 12 months ago. The total employment sector is growing at 1.2, but you can see there is an abrupt decline happening as a result of the declines that we're seeing in the earlier sectors. So 6 months ago, total employment was growing 1.7. As of October, it's only growing 1.2. And then, of course, the non-cyclical, which is more services oriented, it has the strongest current pace of growth, 1.5, previously growing at 2. I would make one caveat of this in this chart is that the growth rate of the first two buckets, residential and durables, as well as total construction and manufacturing, is partially influenced by the hurricanes that we had in October, as well as a strike that went on at Boeing aircraft manufacturing facilities. Both of those two events impacted the durable goods manufacturing sector. So the 0% growth rate for the first bucket and the 0.4% growth rate for the second bucket may be a little bit over dramatic, as it includes the employees that were temporarily laid off because of the strike. But that notwithstanding, the trend is still to the downside. So in the months ahead, we're likely going to see a little bit of a correction upwards in the growth rate of those two buckets as those employees that were on strike get added back. But once that happens, I would expect the trends in those two sectors to continue moving down. Once those first two buckets, residential and durables, as well as total construction and total manufacturing, when those two buckets are experiencing a negative growth rate, which means those two sectors are losing jobs, um, that is very strong alarm bells for the economy in terms of recessionary conditions that are developing in the very near future, as those employees that are now unemployed will create a lot of stress on credit card delinquencies, auto delinquencies, pulling back on restaurant consumption, pulling back on vacation consumption, and things like that. So, as you can see, we're slowing in those sectors. We're not yet contracting. So right now we should just be on alert, but it's not a immediate concern in terms of contractions in employment in these really critical sectors.
Okay, that makes a lot of sense. So, what does this all mean for markets? I guess it's hard to tell, and it depends on the data that comes forward. But I imagine at least for the next few months, it seems that things are probably quite positive, constructive, potentially going the same trajectory. And then after that, depending on the data, it could
Yeah.
go down.
So,
What are your thoughts?
right. So I think that your interpretation is largely correct. And I just want to make a distinction of the word markets, right? When we say markets, or most people say markets, that generally refers to the S&P 500. And we have to remember that the S&P 500 is a combination of the 500 largest companies, and it's disproportionately impacted by the top 10 companies, which at this point are very much service sector oriented companies in the form of Google and Apple. And while sometimes they produce hardware products like iPhones, they very much have subscription like revenues that are impacted or tied mostly to that lagging or services economy bucket. If you go to smaller industries, like if you take the Russell 2000 small cap index, that represents 2000 companies, which is about 60 or 70% of the investable universe. Those companies are roughly at the same level today as they were in 2021. So they've gone basically 3 years with no increases in their share prices as a group. And that's primarily because of those slowdowns that we're seeing in that cyclical bucket, because since those are more industries that are tied to the real economy as opposed to the more monopolistic companies that make up the S&P 500. And if you go one level smaller than that to the micro cap index, which is represented by something like an ETF IWC, it's the Russell Microcap Index, those stocks are lower today than they were in 2021. So you can see sort of how the economy moves in a sequence where you have leading, cyclical, aggregate, and lagging data. The contractions appear in the leading, they spread to the cyclical, then they spread to the aggregate, and then they spread to the lagging. The same type of phenomenon appears in markets where contractions start with the smallest, least healthy or least dominant companies. They spread to slightly larger companies. Then they spread to only last the more monopolistic S&P 500 companies. So I would expect the trends that we're seeing in the markets to persist. But what that means is probably still really weak performance for your micro caps, small companies, since they're going to be very tied to the more cyclical real economy sectors, which are starting to experience contractions. Eventually, it will show up more dominantly in the small cap indexes, which are still not performing that well, really no gains over the last 3 years. The largest S&P 500 companies, so long as that aggregate economy bucket remains pretty stable and roughly around trend, which it is right now, will continue to move higher as those company profits will continue to do quite well. So, we have to, I think, get a little bit more granular when we talk about markets, unless we're just only talking about the S&P 500. In that case, the trends, I think, probably do continue as long as those aggregate economy statistics that I referenced in those charts remain stable and remain roughly at trend levels. Then the S&P 500 will do well. But we should also keep in the back of our mind, although it's not as heavily invested in, the trends that are in the microcap index as well as the small cap index, because those will be somewhat leading indicators of what happens in the larger companies, just as the leading economic indicators as well as the cyclical economic indicators are leading indicators of what will come for the aggregate and lagging economy buckets.
Yeah, great. Thanks for the nuance there. And I think it's, as you said, definitely needed based on how they're weighted to different parts of the economy. But Eric, thanks so much for your time today. I think we almost got through all your slides. But my last question is, what is one message you'd like people to take away from our conversation?
So thank you very much for having me on, and I'm glad we got a chance to do this update. So I think that the most important thing is to remember that the business cycle does operate in a sequence or an order of operations. And you can go back to any business cycle you want, going all the way back to the 1950s, 60s, 70s, inflationary periods, non-inflationary periods. The sequence always remains the same. The lead and lag time between each step or each bucket, as referenced in those charts, can be different and also can be somewhat unpredictable because there's a lot of exogenous factors that play into it. So I would focus on the sequence, use the sequence to guide the view of where things are likely heading in the future, and embrace some of the more uncertain elements in the precise lead and lag time. Everyone wants the holy grail. Everyone wants the phone call the day the aggregate economy starts to move lower. No one's been able to provide that because it is somewhat unmodelable or unpredictable. But we can use the sequence to tell us what the next step will be, and just remain alert and remain, abreast of all the things that are going on to give us the best indication of when that will happen from a timing perspective. But that's the big thing I think is worth taking away from this conversation, is that the sequence is the same. The sequence is reliable. The sequence will remain the same as long as we remain in a free market and credit-driven system. And that's the best indications that we can use in the economy to guide, your asset allocation, your defensive or offensive positioning in markets, or if you're running a business, particularly a business in the more cyclical sectors, whether it's a good time to expand operations, cut operations, try and do things to get ahead of competition. So I think that sequence or order of operations is really what I spend my time focusing on, as well as talking about, and hopefully convincing people that that's what really matters as far as using that to determine where things are going in the future.
Yeah, great. Thank you so much for the message and for your time today. I think it's, I've learned a lot of that. I'm sure the audience has as well. So really appreciate that. If anyone wanted to find out more about your work and what you do, would sort of EPB Research be the best place for that, or is there anywhere else?
Yeah, so you could find me on Twitter or X at EPB Research. You could go to the website, epbresearch.com, or you could find me on Substack, EPB Research there. I publish some free stuff as well, very much along the lines of this business cycle dynamics, giving updates on where all of this is heading.
Great. I'll put it all in the description below, but thanks again for your time.
My pleasure. Thanks so much.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.